There's a financial weapon sitting in the global banking system right now that makes nuclear bombs look safe by comparison. $900 trillion in derivatives. That's not a typo. $900 trillion. 12 times the GDP of the entire world. Held by just 4 American banks. To put that number in perspective, if you spent $1 million every single day, it would take you 2.5 million years to spend $900 trillion. That's how much leverage is sitting in the financial system right now. That's how big this bomb is. If you stacked $900 trillion in $100 bills, the pile would reach from Earth to the moon and back. 17 times. That's the scale of what we're dealing with. That's the weapon that's pointed at your retirement account right now. And here's what should terrify you. The last time derivatives exploded, in 2008, they nearly destroyed the global financial system. The market back then was $600 trillion. Today it's $900 trillion. 50% bigger, 50% more dangerous. And absolutely nobody has fixed the underlying problem. In fact, they've made it worse. The banks that survived 2008 didn't get smaller. They got bigger. They absorbed the failed banks. They took on more derivatives. They increased their leverage. The system that almost collapsed became more concentrated, more fragile, more dangerous than it was before the crash. And the regulators who were supposed to prevent this, they approved every merger. They signed off on every increase in leverage. They gave the banks exactly what they wanted. Because the same people who regulate the banks used to work for the banks. And when they leave government, they go back to the banks. They're not protecting you. They're protecting their future employers. If this bomb goes off and the math says it will, 2008 will look like a minor correction. Not because I'm predicting it. Because history has already shown us what happens when derivative markets collapse. 3 times. 3 different crises. 3 complete meltdowns. And every single time the people in charge said the same thing. We've got it under control. The risk is contained. This time is different. They were wrong every single time. And if you think this doesn't affect you because you don't trade derivatives, think again. Your pension fund holds them. Your bank's balance sheet is built on them. Your 401k is exposed to them. Every dollar you have in the financial system is connected to this $900 trillion web. When it breaks, your money doesn't just lose value. It could disappear. Every mutual fund you own, built on derivatives. Every index fund, derivatives underneath. Your company's corporate bonds, hedged with derivatives. Your municipal bonds financing local infrastructure, derivatives insuring them. There isn't a single financial instrument in existence today that isn't either a derivative or connected to derivatives through multiple layers of counterparty relationships. If you're getting value from this breakdown, hit that like button right now. It helps more people see this information before it's too late. This is the story of derivatives. How they work, why they're designed to fail, and why your retirement account is sitting on top of the largest financial time bomb in human history. Let me show you what happens when derivatives explode. Let's start with the first modern derivatives catastrophe. Long-term capital management, 1998. This is where the pattern begins. LTCM wasn't some reckless startup. This was a hedge fund run by literal Nobel Prize winners, Myron Scholes and Robert Merton, the guys who invented the mathematical models that Wall Street uses to price derivatives. These were the smartest people in finance. The experts everyone trusted. John Meriwether, the founder, was a legendary bond trader from Salomon Brothers. He recruited the best minds in finance. Former Fed Vice Chairman David Mullins joined the team. They had connections at every major bank. They were seen as untouchable, and they built a fund based entirely on derivatives trading. Their strategy was simple. Find tiny price differences between similar bonds in different countries. Bet billions on those differences disappearing. Use derivatives to amplify the returns. And it worked. For 4 years, LTCM printed money. In 1997, they made a 40% return. They had $4.8 billion in capital. But here's the thing, they controlled $1.25 trillion in derivatives positions, a leverage ratio of 25 to 1. Every dollar they had was controlling $25 of risk. The partners thought they were invincible. They'd back-tested their models on decades of data. They'd accounted for every scenario they could imagine. The math was perfect. The risk was minimal, or so they believed. But here's what they didn't account for. Human panic, contagion. The fact that when one market moves, others follow. Their models assumed independence. Reality proved them wrong. And here's the detail that makes it even more ridiculous. LTCM's partners had personally invested most of their own wealth in the fund. These weren't just reckless traders gambling with other people's money. They believed so completely in their models that they risked their own fortunes. Hubris at its purest. Then Russia defaulted on its debt in August 1998. Global bond markets panicked. Prices moved in ways LTCM's models said were impossible. Statistical impossibilities. Events their Nobel Prize-winning models predicted would happen once every billion years. Except they happened in 1 week. LTCM started losing money. Fast. $500 million in a single day, then $1 billion, then $2 billion. Their capital evaporated. But their derivative positions, those were still there. $1.25 trillion in obligations that had to be unwound. And here's where it gets terrifying. LTCM owed money to every major bank on Wall Street. If they collapsed, they'd trigger a cascade of defaults. Bank to bank, derivative to derivative. A chain reaction that would take down the entire financial system. The Federal Reserve had to step in. They organized a $3.6 billion bailout. 14 banks chipped in. Not because they wanted to, because they had to. Because letting LTCM fail meant they all failed. Think about what that means. The smartest people in finance, Nobel Prize winners, former Federal Reserve officials. They built a mathematical model that was supposed to be foolproof. And it nearly destroyed the entire banking system in 2 weeks. This was 1,998. One hedge fund, $1.25 trillion in derivatives, almost destroyed the global banking system. The broader impact? Global stock markets lost 20% of their value in weeks. Pension funds took billions in losses. The crisis spread to Brazil, threatening their currency. It took months for markets to stabilize. All because one fund's derivative bets went wrong. And the lesson Wall Street learned? They could trade more derivatives, get bigger, and the Fed would bail them out if anything went wrong. So they did. Let's jump forward 10 years. 2008, the big one. This time, the weapon wasn't complex bond arbitrage. It was mortgage-backed securities and credit default swaps, derivatives built on home loans. Here's how it worked. Banks made mortgages. Then they packaged thousands of those mortgages into securities. Then they sold those securities to investors. Then, and this is the key part, they created derivatives called credit default swaps that let people bet on whether those mortgages would default. It was insurance on mortgages. Except it wasn't really insurance, because the people buying the insurance didn't have to own the mortgages. Anyone could buy a credit default swap on anything. You could bet billions on mortgages you'd never seen, in cities you'd never visited, made to people you'd never met. And Wall Street sold these things like crazy. By 2007, the credit default swap market was worth $62 trillion. That's 4 times the GDP of the United States. Most of it concentrated in a few banks, JPMorgan, Bank of America, Citigroup, Goldman Sachs. The banks called them risk management tools. They told regulators the derivatives made the system safer by spreading risk around. But what they actually did was create a web of interconnected bets where everyone owed everyone else money. And nobody knew how big the real exposure was. AIG, the insurance giant, sold credit default swaps on hundreds of billions in mortgage securities. They collected premiums for years. Easy money. But they didn't set aside reserves to pay claims. They assumed housing prices would keep rising forever. The man running AIG's financial products division was Joseph Cassano. He famously said in 2007 that it was hard to see how they could lose even $1 on their credit default swaps. 6 months later, AIG needed a $182 billion government bailout, the biggest in history. But here's what makes it worse. AIG had sold credit default swaps to Goldman Sachs. When AIG couldn't pay, the government stepped in. And where did a huge chunk of that $182 billion go? Straight to Goldman Sachs. The taxpayers bailed out Goldman's bad bets. And nobody went to jail. In fact, Goldman Sachs got $12.9 billion from the AIG bailout. They claimed they were fully hedged and didn't need it, but they took it anyway, public money, for their private bets. And the Treasury Secretary who approved it? Hank Paulson, former CEO of Goldman Sachs. Then housing prices stopped going up. Mortgages started defaulting. The securities built on those mortgages lost value. The credit default swaps, the insurance got triggered. Billions in claims, then tens of billions, then hundreds of billions. And here's the problem. The banks that sold the credit default swaps, the insurance companies, didn't have the money to pay the claims. They'd sold insurance on trillions of dollars of mortgages with only billions in capital. Bear Stearns collapsed in March 2008. Lehman Brothers collapsed in September. AIG, the biggest insurance company in the world, would have collapsed if the government hadn't given them $182 billion. But it wasn't just them. Washington Mutual, the largest savings and loan in U.S. history, collapsed, seized by regulators, $307 billion in assets, gone in days. Wachovia Bank, the 4th largest bank in America, nearly failed. Had to be absorbed by Wells Fargo in an emergency merger. Merrill Lynch, a 4-year-old investment bank, sold itself to Bank of America to avoid bankruptcy. The entire global financial system was hours from complete shutdown. Banks stopped lending to each other, credit markets froze, the real economy, the one where people have jobs and businesses operate, started collapsing. The Federal Reserve had to inject $16 trillion into the banking system to keep it alive. $16 trillion. They printed money and gave it to banks to cover their derivative losses. 8 million Americans lost their jobs, 10 million lost their homes, retirement accounts got cut in half, small businesses couldn't get loans, unemployment hit 10%. The stock market lost half its value, college graduates couldn't find work, families lost their life savings, an entire generation's wealth gone. And the banks that caused it, they paid themselves $20 billion in bonuses in 2008 with bailout money, while people were losing their homes. All because of derivatives. Financial weapons that were supposed to reduce risk, but instead concentrated it in the hands of a few banks. And after 2008, after the bailouts, after the hearings, after all the promises of reform, did they reduce the derivatives market? No, they made it bigger. Now let's look at recent history, because the pattern is happening again. Smaller explosions, warning shots, proof that nothing was fixed. March 2020, Credit Suisse collapses, a bank that survived 165 years gone in days. Why? Because they had massive derivative positions that blew up when interest rates moved. They had to be absorbed by UBS in an emergency weekend takeover orchestrated by the Swiss government. The Swiss government had to change laws on a Sunday to force the merger through. They had to guarantee $9 billion in potential losses. It was that urgent. And here's the detail nobody mentions. Credit Suisse shareholders got wiped out. But the bondholders, they lost everything too. $17 billion in bonds gone. People who thought they owned safe investments in a 165-year-old bank lost it all in a weekend. March 2023, Silicon Valley Bank fails. Then Signature Bank. Then First Republic. 3 major banks in 3 weeks. The reason? They had derivative positions betting that interest rates would stay low. When rates went up, their derivatives lost billions. Silicon Valley Bank alone had $27 billion in unrealized losses. Their derivative book was leveraged 200 to 1. When depositors figured it out, they pulled $42 billion in a single day. The bank collapsed in 48 hours. Think about that. A bank that had been operating for 40 years, destroyed in 2 days because of derivatives. First Republic Bank was the next domino. They had served wealthy clients for decades. $213 billion in assets. When the panic spread from Silicon Valley Bank, depositors fled. The bank lost $100 billion in deposits in 2 weeks. JPMorgan bought the carcass in a government-brokered deal. Another too-big-to-fail bank got bigger. And here's what nobody talks about. Each of these banks had derivative positions worth tens of trillions of dollars. When they collapsed, those positions had to be unwound. Other banks had to absorb the losses. The Federal Reserve had to step in with emergency lending facilities. The Fed created a new program called the Bank Term Funding Program. They lent banks $300 billion in just 3 months. Emergency money to cover derivative losses. Nobody called it a bailout, but that's exactly what it was. And it gets worse. The FDIC insurance fund, the thing that's supposed to protect depositors, had only $128 billion in reserves when Silicon Valley Bank failed. One bank failure cost more than the entire insurance fund. How do you think that works when 10 banks fail? Or 50? The FDIC is now proposing to increase insurance premiums on banks to rebuild the fund. So who pays? You do. Either through higher fees or through reduced interest rates on your deposits. The banks gamble. You pay when they lose. Sound familiar? These weren't isolated incidents. These were stress fractures in a system that's holding too much weight. And the weight keeps growing. After Credit Suisse failed, their derivative positions $3 trillion worth got transferred to UBS. After Silicon Valley Bank failed, JPMorgan absorbed their derivative book. The system isn't getting safer. It's getting more concentrated, more fragile, more connected. One bank fails, the contagion spreads. Bank to bank. Derivative to derivative. Just like 1,998. Just like 2008. Except now, the numbers are bigger. The connections are deeper. And the next crisis won't be contained with a few $1 billion or even a few trillion, because the derivative bomb is now $900 trillion. And when it goes off, there isn't enough money in the world to stop it. Before we talk about what's coming, you need to understand what derivatives actually are. Not the sanitized Wall Street version, the real mechanics. A derivative is a financial contract whose value is derived from something else. A stock, a bond, an interest rate, a currency exchange rate, anything. Think of it like this. You don't buy the house. You buy a contract that pays you if the house price goes up or down or stays the same. You can create a derivative on anything. The key feature of derivatives, leverage. You don't need to put up the full value of the bet. You put up a fraction, maybe 5%, maybe 1%, and control the whole position. This is how $10 billion in capital controls $1 trillion in derivatives. Leverage, the amplifier that turns small movements into massive profits or catastrophic losses. There are 4 main types of derivatives. Interest rate swaps bets on whether rates will rise or fall. Credit default swaps insurance on whether debt will be repaid. Currency swaps bets on exchange rate movements. And commodity derivatives contracts on oil, gold, wheat, anything physical. Each type can be combined, stacked, and leveraged. A bank can create a derivative on a derivative on a derivative, complexity stacked on complexity, until nobody, not even the traders, fully understands what they own. Here's what makes derivatives a weapon instead of a tool. Every derivative is a contract between 2 parties. If one side can't pay, the other side loses everything. And in a crisis, everybody fails at once. Bank A owes Bank B owes Bank C owes Bank A. When one falls, they all fall. Banks don't report their full derivative exposure. They report net positions, what they owe, minus what they're owed. So a bank might report $50 billion in derivatives. But their actual exposure, the total amount they've bet, might be $5 trillion. You don't know until the crisis hits. This opacity is deliberate. Banks lobby against transparency requirements because revealing their true exposure would terrify investors and regulators. So the real numbers stay hidden in footnotes that nobody reads until it's too late. Derivative models assume things are independent. That housing prices in California won't affect housing prices in Florida. That bond markets in Europe won't affect bond markets in Asia. These assumptions work until they don't. And when they break, everything moves together. Every hedge fails simultaneously. This is what happened to LTCM. Their models said Russian bonds and European bonds were independent. When Russia defaulted, European bonds crashed too. All their hedges failed at once. In normal times, derivatives trade easily. Banks buy and sell them constantly, but in a crisis, the market freezes. Nobody wants to buy, nobody wants to take the other side. And suddenly, your $10 billion derivative position can't be sold at any price. You're stuck holding a ticking bomb. The people who regulate derivatives used to work for the banks that trade them, and when they leave the government, they go back to those same banks. This revolving door means regulations are written by the industry they're supposed to control. Every attempt to restrict derivatives gets watered down or delayed. The banks write their own rules. Most derivatives don't trade on open markets. There's no price you can look up. So banks value them using internal models. They decide what their derivatives are worth. And surprise, they always value them favorably, until a crisis forces them to admit the truth. Then the mark-to-model valuations collapse to their real value, often zero. This is the practice of using the same collateral for multiple derivative positions. A bank puts up $1 billion in treasury bonds as collateral for a derivative. Then they lend those same bonds to another bank, who uses them as collateral for their derivatives. The same $1 billion supports $10 billion or $50 billion in derivative positions. When the chain breaks, there isn't enough collateral to cover the losses. Banks use netting agreements to reduce their reported exposure. If Bank A owes Bank B $50 billion and Bank B owes Bank A $48 billion, they report the net as $2 billion. This makes their exposure look tiny. But in a crisis, when one bank can't pay, the entire $50 billion becomes due. The netting collapses, and suddenly the manageable $2 billion exposure becomes a $50 billion crisis. Rating agencies like Moody's and S&P are paid by the banks to rate their derivative products, not by investors, by the banks themselves. This creates an obvious conflict of interest. The agencies that gave AAA ratings to mortgage securities in 2007 are the same agencies rating derivatives today. They have every incentive to give favorable ratings, and no accountability when those ratings prove wrong. After 2008, regulators required most derivatives to be cleared through central counterparties, clearing houses that stand between buyers and sellers. This was supposed to reduce risk. Instead, it concentrated all the risk in a handful of institutions. The CME Group, ICE Clear, LCH. If any one of these clearinghouses fails, the entire derivatives market collapses instantly. They've created single points of failure in a system designed to have none. Now let me show you how these pieces fit together. Banks use derivatives to hedge risk. That's the theory. I own stocks, I buy derivatives that pay me if stocks go down. I'm hedged, protected. But here's the trap. When one bank hedges, someone else has to take the other side. So risk doesn't disappear, it just moves. And in practice, it all moves to the same place, the biggest banks. JPMorgan Chase holds $54 trillion in derivatives. Bank of America holds $21 trillion. Citigroup holds $42 trillion. Goldman Sachs holds $44 trillion. 4 banks. $161 trillion in derivatives. That's 500% of US GDP, held by 4 institutions. These banks are all counterparties to each other. They all owe each other money. If one fails, the others have to absorb the losses. And if the losses are big enough, they all fail together. This is what regulators call systemic risk, the polite term for, if this breaks, the entire financial system collapses. And here's the final piece, the one that makes this inevitable. The derivatives market is built on a foundation of debt. Banks don't use their own money to trade derivatives. They borrow money, cheap money, money borrowed at 1% or 2% interest rates. For 15 years, from 2008 to 2022, interest rates were near zero. Banks could borrow unlimited amounts for almost nothing. So they did. They borrowed trillions. And they used that money to build the $900 trillion derivative tower. But now interest rates are up, 5.5% and rising. The cheap money is gone. And all those derivative positions that were profitable at 1% rates are losing money at 5.5% rates. The foundation is cracking. And when it breaks, the whole tower comes down. So where are we right now? Let me show you the current state of the derivative bomb. That's according to the Bank for International Settlements. The official number, the real number, the actual exposure if you counted everything, could be higher. Some estimates put it at $1.2 quadrillion, but let's use the conservative number, $900 trillion. To put that in perspective, global GDP is $100 trillion. The entire stock market is $100 trillion. All the debt in the world is $300 trillion. The derivative market is 3 times larger than all debt, stocks, and real estate combined. Just like LTCM, just like 2008, massive leverage on top of the real economy. Check. JPMorgan, $54 trillion. Citigroup, $42 trillion. Goldman Sachs, $44 trillion. Bank of America, $21 trillion. These 4 institutions hold 180% of US GDP in derivatives. If anyone fails, they all fail. And it's not just American banks. Deutsche Bank in Germany holds $43 trillion. HSBC in the UK holds $27 trillion. BNP Paribas in France holds $49 trillion. The top 10 banks globally control over $400 trillion in derivatives, all interconnected, all exposed to each other. Just like how LTCM threatened every major bank in 1998. Just like how Lehman Brothers triggered the 2008 crisis. Interconnection means collective failure. Check. From 0% in 2021 to 5.5% today. The fastest increase in 40 years. Every derivative position built on cheap money assumptions is now underwater. Banks are sitting on hundreds of billions in unrealized losses. The Federal Reserve's own reports show that banks have $650 billion in unrealized losses on their books. That's just what they're reporting. The real number, the mark-to-market value, if they had to sell everything today, is likely much higher. And those losses are growing. Every quarter, as interest rates stay elevated, the unrealized losses increase. Banks are hoping rates come down before they have to recognize these losses. But what if rates don't come down? What if they go higher? Just like Russia's default caused LTCM's models to break. Just like rising defaults broke the 2008 models. Interest rate changes break derivative assumptions. Check. Credit Suisse, Silicon Valley Bank, Signature Bank, First Republic. These weren't accidents. These were derivative failures. And each time, the Federal Reserve had to step in. Emergency lending, backstops, bailouts. Since March 2023, regional banks have lost $500 billion in deposits. Money is fleeing to the big 4 banks, the ones with the derivative exposure. This concentration makes the system more fragile, not stronger. The cracks are showing. The system is under stress. We're in the early stages of the crisis, not the middle, not the end, the beginning. Check. Office buildings are empty. Remote work killed demand. Property values are down 30% to 50% in major cities. Banks hold $5 trillion in commercial real estate loans. And they've written derivatives on top of those loans. When the buildings default, the derivatives trigger. More losses. More contagion. Check. Credit card debt just hit $1.13 trillion. Auto loan defaults are rising. Student loan payments resumed. And banks have written derivatives on all of it. When consumers can't pay, the derivatives trigger. More losses for the banks that are already underwater on interest rate positions. U.S. national debt just surpassed $34 trillion. Annual deficits are $2 trillion. Interest payments on the debt now exceed defense spending. And the banks? They own trillions in treasury bonds. And they've written derivatives on those bonds. When sovereign debt becomes unsustainable, those derivatives trigger. Another cascade. The dollar has lost 97% of its purchasing power since the Federal Reserve was created in 1913, but the pace is accelerating. Money supply exploded 40% in just 2 years during COVID. Inflation hit 9%, real wages declined, and banks have written currency derivatives betting on dollar stability. When confidence in the currency breaks, and history says it always does, those derivatives explode. Another trillion-dollar cascade in a system that can't absorb it. Check. In 1998, it took $3.6 billion to save LTCM. In 2008, it took $16 trillion to save the banks. The next crisis? We're looking at a $900 trillion derivative market. Even if only 10% goes bad, and it'll be more than that, that's $90 trillion in losses. The Federal Reserve can't print $90 trillion. The government can't borrow $90 trillion. There isn't enough money in the system to absorb this. Which means what happens instead? Bail-ins. Not bailouts, bail-ins. The banks take depositor money to cover their losses. Your checking account, your savings account, your money becomes their collateral. It's legal. It's already written into the Dodd-Frank Act, Section 1100. And 4 explicitly allows banks to convert deposits into bank equity during a crisis. That means your cash becomes shares in a failing bank. And when the bank is insolvent, those shares are worthless. And it's already happened. Cyprus, in 2013, bank depositors lost 60% of their savings overnight to cover bank derivative losses. That's what's coming. Not gradual decline, sudden implosion, your retirement account cut in half, your savings frozen, your ability to access your own money restricted. And it's not a conspiracy. It's math. $900 trillion in derivatives, built on leverage, held by 4 banks, connected to everything. When it breaks, everything breaks. 3 times, derivatives have nearly destroyed the financial system. LTCM, 2008, the recent bank failures. Each time, the people in charge said they'd fixed it. Each time, they said it couldn't happen again. Each time, they said the risk was under control. They were wrong. Every single time. We're not in a different situation now. We're in the exact same situation, except the numbers are bigger, the leverage is higher, the connections are deeper, and the next crisis won't be contained. Because the math doesn't work. You cannot build a $900 trillion derivative market on a $100 trillion economy. You cannot leverage banks 30 to 1 and expect them to survive interest rate shocks. You cannot concentrate all risk in 4 institutions and expect the system to stay stable. The sequence is locked in. Rising interest rates break derivative assumptions. Breaking assumptions cause losses. Losses trigger failures. Failures spread through interconnection. And the whole system collapses. The only question is timing. Maybe it happens this year, maybe next year, maybe 2026. But the pattern says it's coming. And when it comes, it won't be gradual. It'll be sudden, catastrophic, system-wide. 2008 will look like a minor correction. 8 million job losses? Try 30 million. 10 million foreclosures? Try 50 million. A few trillion in bailouts? There won't be enough money to bail anyone out. This is what happens when you let banks build weapons of mass financial destruction and call them risk management tools. Warren Buffett called derivatives financial weapons of mass destruction in 2003. 20 years ago, nobody listened. The market was $100 trillion then. It's $900 trillion now. He was right. And we're about to find out just how destructive these weapons are. The difference between 2008 and what's coming? In 2008, governments could still borrow trillions to stabilize the system. Now they're already drowning in debt. In 2008, central banks could cut rates to 0. They're already there. In 2008, there were policy tools left. This time, the toolbox is empty. And when it breaks, it won't matter if you saw it coming. It won't matter if you understand derivatives. It won't matter if you think you're prepared. Because the derivative bomb doesn't discriminate. Your 401k, your pension, your bank account, your ability to access money, all of it is connected to this system. All of it is at risk. The financial system you trust, the banks you think are safe, the regulations you believe protect you, the FDIC insurance you count on, all of it is built on the assumption that derivatives won't fail. But they will. They always do. And when they do this time, the scale will be unprecedented. And here's the final truth they don't want you to know. The central banks, the Federal Reserve, the European Central Bank, the Bank of England, they know this is coming. They've run the simulations. They've seen the models. They know the system is unstable. And they've decided that your savings are acceptable collateral damage to keep the banks alive. They've already chosen. And they chose the banks over you. Not because they're evil, because the entire global financial system depends on these banks staying solvent. If the big 4 fail, global trade stops, supply chains break. The modern economy ceases to function. So when the choice comes your savings or systemic collapse, they'll take your savings, every time. And here's what makes it worse. When the collapse comes, it won't take months like 2008. It'll take hours, maybe days. The speed of modern markets, the interconnection of global finance, the leverage ratios that exceed anything in history, all of it means that when the first domino falls, the entire system goes down before anyone can react. You won't have time to move your money. You won't have time to protect yourself. By the time you realize what's happening, it will already be over. If this information changed how you see the financial system, subscribe to this channel right now. Because when the derivative bomb goes off, and it will, you'll want to understand what happened, why it was inevitable, and how to protect what's yours. The answers aren't hiding in the future. They're written in the past. In LTCM, in 2008, in every crisis that followed the same pattern. And history says the $900 trillion derivative bomb is already ticking.